Hey, everybody. Welcome from Orlando, sunny and rainy Orlando, Florida, where we are.
The Mickey Mouse ears.
Oh, we should have. No, we didn't even have time to get Mickey Mouse ears. So we were at a Sandler training conference, so we're getting trained. Hopefully we'll get trained even more. We like our coach on that, and he invited us to come, so that's pretty cool. And Jack is in the studio booth with the subliminally overt background, which we love. So I think what we'll do is, as you guys are getting on here, you know the drill. Q&A is where the questions go. And you can harass us in the chat. And before we get going, we will do some polls. We're going to continue on this theme from some of the top 100+ questions. We won't get to all of those, obviously, but things that we deal with all day, every day, it seems like. And Jack has an update. You should have the Washington background, though. So anyway, go with what you got.
Couldn't make it out there today, so you're gonna have to. This is what I got. So just kind of two quick updates, but important updates for business owners, which is that so yesterday, maybe last night, the much anticipated 1.5 trillion omnibus legislation to fund the government for the rest of the year came through. That includes 13.6 billion for Ukraine security and humanitarian needs, 14.6 billion in COVID-19 health related spending, and new cancer research funding. Interestingly, there is no money for they're saying hard-hit industries, but basically for relief for businesses, for small businesses. I think the range that they were looking at, so the Senate was talking about 68 billion for a relief package for businesses. And then the range was between 40 billion and 60 billion. And at the end of the day, the number is zero. So, it's not looking good for any money going towards businesses in the form of PPP type assistance or anything like that. So that is, who knows, things change all the time, but at least not in the budget. So it's not coming your way anytime soon, which is a huge disappointment. Understand that we have obligations, humanitarian obligations and otherwise, but to kind of look the other way with respect to what's going on in our own country with our own citizens. And I'm not trying to be political or make a political statement. I just think that I'm very surprised that the number is zero. So the other is that there is this push to, and whether you call them gig employees, independent contractors, whatever it may be, but it comes up in the franchise context. It comes up in the Uber and Lyft context, where you have the desire amongst the federal government, the Department of Labor in particular, to reclassify these what are traditionally independent contractors into being employees. There are various reasons for doing that. And the more kind of nefarious ones are that they want the ability to employers or to leverage off of being able to create unions, because now you have employees instead of independent contractors. So whether you call them W-2 versus 1099, whether you call them, and there's different measurements for that, seasonal employees. We've talked about Uber and Lyft. So those kind of employees that typically are those individuals that are not typically treated as employees, but treated as independent contractors, they're trying to push that into an employment type of regime, which for me impacts, being in the franchise industry, the legal industry, significantly impacts my franchisors that now the employees may become their employees rather than independent contractors, and even the fundamental core franchise relationship. So a franchisee, when you walk into that McDonald's here in Charlotte and it's run by a franchisee, then there is an independent contractor relationship between the franchisor and the franchisee. So now if you collapse all of that, and the ultimate employee at that place in Charlotte is now technically an employee of the franchisor, you basically just obliterated the whole franchise system concept. So that's going on, and we'll see where that goes. The resistance is that there is a Biden nominee for the Department of Labor Wage and Hour Division Secretary, and he is the one that is trying to push millions of independent contractors into the employee category. So those are kind of the two of the bigger things that have been going on in the past week or so. And so that is your current news update.
Wow. There's a lot of stuff going on there. And not all of it's good. But stay tuned, we never know where that's going to lead. So I'm going to launch a poll, y'all. And it is going to be on Cash Flow 101. And what I would love for you guys to do is vote. Which of these questions would you like us to address? First one is, what's cash flow and how do I figure it out? What drives cash flow is number 2. 3, how do I predict cash flow and project cash flow? What do banks look for? How much cash or working capital do I really need? So keep voting. So far. All right. Oh, we have 2 of them that we might want to address.
Got them covered. I figured those would be the 2.
All right. We're going to go ahead and so the last 2 questions are the ones that we're going to go ahead and tee up Adam to go ahead and launch into.
Yeah. So, the first one we'll knock out first is, how much working capital do I need? And, working capital, really is, kind of operating flow to keep the business, functional to where you can pay your ongoing obligations, which, operating flow is typically, inventory, receivables, you convert those into cash, funding to pay expenses, that's, pretty much payroll, buy materials, purchase inventory, pay your rent, pay your accounts payable, things like that. So the classic definition is, cash plus AR plus inventory divided by, accounts payable and, other current liabilities, which I'm not going to get into the whole formula there, but that's the classic definition. So how much do I need? We get asked this question a lot. And the answer is how much you need and what, not 1 penny more, for a lot of reasons. And, the 2 reasons to have not 1 penny more, there's really 3 of them. First off, if you get sued, then the tangible thing that exists in your balance sheet that somebody can sue you for is your working capital, meaning your cash, that you got. So, we have a lot of clients who are like, oh, I just sleep better at night, having all this cash in my company. Well, if you get sued, guess what, Gary? Thank you for all that cash that you can now afford to pay me. We're going to.
But I don't have any cash.
Yeah, I'm sure Jack can speak more to that. The second reason is that, hey, I just sleep better at night when I've got all this cash sitting down there, and then I'd miss the greatest bull run that we've had. So it's not working for you. In fact, with inflation, it's actually going backwards. There's also some sloppiness that it leads to. And then the last reason is that when it comes to selling your company, one of the fundamental components of consideration is going to be, hey, typically when a company gets sold, they're going to buy working capital. So they're not going to say, Gary, how much working capital do you think this business really needs? They're going to say, Gary, we're going to look at the last 12 months. We're going to take an average, and that's what we're going to use. So if you've been keeping excess around, which usually shows up as a big bank account, that's, you're not going to have a good counter argument and say, oh, I was just kidding. I didn't really need all that cash in there. But if, again, if that's $1 million extra that you didn't need in the business, that's $1 million you just took out of your pocket and gave to the potential buyer really unnecessarily. So how much do you need? There's a lot of different schools of thought on that. One end of the spectrum, trying to get to one end of the spectrum, and the camera's backwards. So one end, whatever it is, one end of the spectrum, a day's worth of payroll, that's probably too lean. The other end of the spectrum, really, I think is, I believe the maximum you need is, really 2 months operating expenses And then if you have cost of goods sold, maybe, 5 days of your cost of goods sold is the max that you need. And again, the calculation is cash plus AR plus inventory, divided by accounts payable. Where you need to not kid yourself in that calculation is if your accounts receivable is aging, obviously that's going to skew. You're going to feel tight because you know what? I'm not converting that to cash. I don't have the money to pay my bills. At the same level, if your inventory isn't turning, then that's going to lead you to a false insecurity too. So oftentimes what I recommend in that 2 months calculation is that cash is cash, use that. But for the accounts receivable, only use stuff that's 60 days or less. And then for inventory, only include things that are turning. Every business has a different definition for turning. So again, you could probably use 60 days there. Like if you haven't sold a SKU of something in 60 days, is it really inventory that's going to convert to cash in the next year? But that's generally, I've never found anybody that needs more than that. And generally speaking, what we advise people to do when they're like, oh my gosh, that means that I can do a pretty big distribution. I'm nervous about that. It's like, well, don't go buy a lake house, Gary. Put it in your personal account, let it sit there for a couple months and just see what happens. And if you continue to build cash, then we could probably go even deeper. If you're like, crap, we got to make payroll. I need, 50 grand from you, Gary. You knew you cut a little bit too deep.
And just a couple of tangential points on that, and this may sound familiar, going back to the beginnings of the whole PPP and when they were talking about need and that kind of thing. So consider this, that, and this happens all the time, and that an owner will use, and I mentioned this maybe even a couple of weeks ago, the owner will use their bank accounts as their undistributed cash to themselves. And so therefore it inflates all the asset side of things, and therefore inflates everything. And shows, higher numbers as far as working capital, and then a presumption that is required working capital. So if the money is yours and you've paid taxes, pull it out for a number of reasons. One of them being it shouldn't be in there in the first place, and secondly, Adam had mentioned it's just not efficient as an investment to just sit there. What happened with the PPP, and this is just a real life example, is that when you start talking about need, it's like, okay, well, wait a minute. You start looking at your balance sheet and you say, oh, this is flush with cash. And then, so do you really need that money? It comes up in business negotiations as far as buying and selling businesses as to, okay, you have all this cash in there. And so again, there's a presumption that is a valid number that you need to run the business. A side note to that is using the cash asset balance as your insurance policy for obligations. So for example, warranty, or maybe a litigation reserve. So instead of putting a reserve, a corresponding asset, and I'm way getting into your guys' world, so if I say something that's incorrect, then please feel free to correct me. But instead of having a corresponding asset like restricted funds and a liability for liabilities, contingent liabilities, that you're just saying, well, it's all in cash, so we know if we have a problem, we're just going to pull it from cash to deal with this liability. And so then again, your cash number just isn't accurately reported and can be misconstrued. So a couple of things to think about, that it's just, you want to be accurate in those numbers for a number of reasons, whether it's operational, whether you're buying and selling businesses, those kind of things, because that's what CPAs and accountants look for in transactions with respect to net working capital numbers.
So David has given us a good question on these lines. This is good. If we're a seasonal business, we only make money 3 months out of the year, but we have substantial deposits and prepayments. What would you suggest happens for the months when we have lots of money in the bank that we haven't yet booked?
Yeah, it's a good question. The technically correct answer is you would have a current liability called customer deposit or deferred revenue. So it would somewhat self-correct in terms of making sure you have sufficient working capital on hand, because your liabilities would be a lot bigger, which means your assets need to be a lot bigger. And your primary asset in that case is the cash that you already collected in the form of a deposit. The only downside of that is it might overstate things a little bit, because part of that customer deposit or deferred revenue number also has profit, built into it. So it doesn't necessarily represent the true cost that's going to have to go out the door. So if you wanted to get a little bit more laser like, you might say, deferred rev, my working capital number is only going to be, 75% of that liability is what I'm going to use for the purpose of calculation. If you don't book it at all, though, the problem that people run into is they basically create their own Ponzi scheme. So what you want to avoid is the case where, thanks for the deposit, Gary. I'm not going to take Gary's deposit and use it to go pay for Jack's work, because I already blew the money. And then that eventually,
The music stops at some point.
the music stops. I mean, this is like classic in construction, especially residential construction. Yeah, ready to get started. Just need a deposit from you because I blew the money on drugs and alcohol and whatever.
New trucks.
Yeah, new truck. That would be the good purpose that they use
Right.
it for. So, and then next thing those problems happened, and my work is ready to get performed. I've given a deposit, and the contractor's bankrupt because they blew all the customer deposits. So you just want to make sure that you're not operating your business that way and using your customers' deposits for float for other people's work, which is the importance of actually keeping track of it, knowing what your obligation is going to be.
Great question. All right. So there's another question in that topic, which was, what do banks look for and how should I use debt?
Cool. So we should have like a little pin that I can go, and then we go across the board. So what do banks look for? And I'm going to be specific to cash flow, because a lot of, well, I'll speak to the assets first off. First off, they want to see, generally most banks, even though we're cash flow lenders, they still want to see that you have, assets on your balance sheet that are somewhat relational to the amount of debt that they're going to give you. So I've got $1 million in assets. Maybe I get $750,000 in debt. So there's always going to be some sort of correlation based on the nature of your business with most banks that deal within our customer base, or you've got personal assets that they can attach to that otherwise, because I love all of our banking partners, but they operate with an assumption that there's 100% likelihood that you're going to default and screw them. And they don't want to lose their job over that. So they're gonna do their best to try to be secure in their collateral position until such time as you prove that you're trustworthy. It's just, I don't like it either. Neither do they, but they've had some scarring experiences from nefarious people that ruined it for the rest of us. So it's what we're stuck with, accept it and move on. So when it comes to cash flow, generally what they're looking for is that you're generating enough profit, which would be, generically EBITDA, earnings before interest, depreciation and amortization, that you're generating enough profit to pay their debt. So what they're looking for is that there's a ratio between what you earned and what the principal payments on your debt are and the interest payments on your line of credit for a full year. And as long as that ratio, is north of 1.25, the banker is going to feel pretty happy. But really, to operate a healthy business, you really ought to be shooting for 1.5 or 2, generically speaking. So with that in mind, one of the things that people, really need to think about with that is that if you've got an artificially low salary and you take a significant portion of your salary through distributions, while you may slip one over on the bank, and they're not going to use that in their distribution, in their debt coverage. That's what that's called, debt coverage calculation. Good for you, because the bank's saying, oh, well, that's a distribution, that's discretionary only if they make money. Well, most people in our client base, view that distribution, at least at some level, as salary, even though for tax purposes, it's classified differently. So in order for you to not fool yourself and not take on more debt that you can really afford, you really got to put in, some, if not the whole distribution amount, at least some portion of that distribution into your expenses for the purpose of this calculation, to really know, are you generating enough cash flow to take on your debt? So that's the generics. FICO score, they're going to look at that, want something north of 650, a few other things. But in terms of how to use it, it's funny, because we have a lot of clients who are like, I just don't want any debt at all, ever, period. And I totally understand that. I mean, there is something emotionally beneficial to, if the zombie apocalypse truly happens, I could always be a Walmart greeter, and not have to worry about anything. That's a fair emotion and a fear to just respect. But at the same time, if that fear is driving your business decisions, that's fine, that's your choice, but you're leaving money on the table. Because the correct way to use debt really is, look, if I've got an option to, use my cash to buy something that'll generate, a 20% return, and I can only buy one of them, or I can use a combination of my cash plus some debt to buy 5 of them. Why would I not buy the 5? As long as I can afford the debt, why would I not buy the 5? So that's really in my mind, the correct way to use debt, is that you're very intentional about how you're going to use it to fund growth. Or, we had the question about seasonality, fund some aspect of seasonality in your business. So you've got the cash out actually earning money, and you're using, 3% bank money temporarily to get through a seasonal period, while your money is out earning, something a lot better.
You brought up something that I'm going to just throw in a real quick plug. I think we'll do this sometime in the near future, but we've been working with a group that works on helping businesses and their owners improve their FICO score for their business. That business credit score is important, and especially as you're starting out and early on. And a lot of times people don't realize that if you want to be able to get yourself off of, being personally liable for, securing those notes and that sort of thing, having the business set up as its own credit-worthy instrument or, vehicle is really important. So I think we'll do something on that. Here's a question. What do I do with PPP money if I haven't yet been approved?
I'm assuming that's for
forgiveness. Yeah, that's what I'm thinking too.
I mean, I think our position has always been, if you have a high likelihood of forgiveness, there's no harm in distributing it out if you have excess, or spending it on something else if you have a high likelihood of forgiveness.
So, anonymous employee or attendee, let us know if that answered or if we need to go deeper. Okay.
Yeah. Jack, did you have anything else on, your experience on what banks are looking for?
Yeah, I mean, you very much summed it up, which is essentially they want to know that you can pay your obligation, and they want to know that they can go grab your stuff if you don't pay your obligation, and have sufficient amount of stuff, and that they're first in line. So if you already have debt, let's say that you have maybe some financing that you're paying a former owner, they're going to want to subordinate all of that so that they're first in line, and that person who you owe money to is not going to take any action unless certain circumstances are met, whether it's a passage of time, whether it is whatever it may be. So that sometimes can be a difficulty in getting a conventional loan is that if you have one in place and that the payee on the other end is not willing to subordinate. However, the practical result of that scenario is that, hey, payee, if you want to continue getting paid and not put us into bankruptcy, we need this financing. So you need to step back into the second position and allow the bank to get into the first position, and we can pay everybody, both sides. So that's typically how that goes down.
Cool. I'm going to go ahead and launch another poll. Here we go. While we're talking about cash, I figured this would be a good one. So please vote. Finding cash in your P&L. First one is, how can I fix and avoid problems with my P&L? 2, how do I manage and measure gross profit? 3, how do I manage labor costs? 4, how do I manage overhead costs? 5, what about benchmarking, budgeting, and forecasting? The cool part about asking these questions is oftentimes we may feel like we're stupid because we don't know the answer to this question, but guess what? A lot of people deal with these same questions. That's why they're in our top 100. So it looks like we got a clear winner on benchmarking, budgeting, and forecasting. And might want to even dive a little bit deeper. You know, number 2 is coming in is, how do I fix it and avoid problems with my P&L? If you asked, or, you know, hit that as the poll question that you really wanted to address, hit us in the Q&A if you want to go deeper so we can get specific on that.
Yeah, cool.
Robert, yeah, shameless plug. All right, use Survival CFO to fix your P&L problems.
Yeah, that's right.
Right on, Robert.
Yeah.
It's good to see you here.
That's pretty funny. Yeah. So, first off, so budgeting, forecasting, and benchmarking. So just some terminology for a minute. You know, benchmark is comparing yourself against either yourself in a different period or against, you know, your peers to either see if you're at the average or what it would take to get to a best practice. A budget, you know, you kind of do once a year, you know, or once every 3 years or whatever, that says, hey, here's where I would like to go. And then a forecast is, all right, I'm currently here. What do I need to do next to reach my destination? So it's kind of more real-time GPS behavior. So just general rule of thumb, you know, our thought process in terms of, you know, kind of best practices are, you know, 1, you know, benchmarking, you know, kind of in a minimum, probably once every 3 years or so. You know, best practice would be once every year, obviously. Budgeting, you really should do that every year, and have that be kind of a, you know, start with the top line, you know, budget, you know, what do you think you can get to, you know, you could start with a top line budget and then build it from the bottom up, you know, and then start working on gross profit and then start working on, you know, the operating expense side, so that, you know, kind of, if you're a calendar year, you know, maybe by November, you've got a pretty well thought out budget for the rest of the year. And then, you know, updating your forecast monthly, you know, that shouldn't be very difficult to do once you've got a pretty solid budget in place, and making decisions based on it, you know, like using the data to tell you, do I need to make any changes to try to get back onto the budget, or to, you know, maybe the budget's blown and I need to do something different. So those are just some basic thoughts. You know, I think a lot of our clients, you know, I can't get good benchmarking data, so I'm not going to do it. You know, people are all liars, you know, that are out there. Maybe, you know, maybe they are. So at a minimum, you know, if you're not hitting at least kind of a 15%, you know, owner benefit, meaning like owner salary plus distributions plus owner fringe benefits, if you're not hitting at least that as your bottom line, just start there, you know, and build from there, you know, kind of back into what would have to happen to make that 15% number happen, you know. Or maybe you set like a personal income goal, you know, and say, okay, I take personal income goal, if I'm not there yet, divided by 0.15, And that's what my top line needs to be. I need to either be there or not there. And, you know, then start trying to creep it up, you know, 15% was great. I'm there. Now let's go for 20%. You know, hey, I'm at 20%. Let's go for 25%. I think our experience has been, it's pretty tough for anybody, you know, to beat kind of a 35% number. So, I mean, if you can kind of shoot for the 25 to 35% range, I don't care what benchmarking survey data you pull out, you will be best in class in whatever you do. If you're hitting that kind of target overall. Now, a lot of people will say, like general contractors, can't do it. We're a 5% business. That's BS. You know, we have general contractors that beat that. So for everybody that says, I can't do it, I will say, yes, you can. You've just not figured out how to do it yet. So anything's possible. I mean, you use the general contractor as an example. It's not that I like to pick on them. It's just, they always, we're screwed. How many scope changes did you have that you did not bill for? You know,
Or things in your contract that didn't allow for inflationary things
Right.
and delays, you
Yeah.
know?
Yeah. How many times did you have project managers that weren't on top of estimated cost to complete, communicating correctly with the client? You know, like if you ask that, if you drill into the question like that, almost every general contractor that we have that is not at 15% in terms of owner benefit will say, yeah, I have a lot of that. And then we say, well, how much would that represent to your gross profit? I don't know, 2-3%. Okay, well, there you go. Because when you take, you know, $50 million general contractor times 3%, guess what? That 3% has no cost associated with it. That all flows straight to the bottom line. Suddenly, you're back at my 15%, showing you that it's possible if you just
Mhm.
start driving process. I mean, restaurants would be the same way. It's impossible. I don't know. I mean, do you have room to move up on your prices a little bit? You know, do you have, like, you know, when one of my favorite restaurant clients, you know, who, you know, has kind of best in class labor rates, he's like, how'd you do it? He goes, well, they asked me for 2 prep cooks, so I took 1 away. You know, it's like managing the business based on stuff that you know to be true using the data versus like, here's how far, I'm so busy, I need more people. You know, use the data to start making your expense decisions. Like, how many times, I'm sure, Jack, I'll throw you a softball. How many times do you hear at Shoemaker, because I mean, you're a business too, you got to go through the same process, we need 4 million more paralegals and attorneys, and blah blah.
That's the way my mind was working actually this morning in going through my stuff, because I'm also taking off next week, and there's that karma of, oh, let's call Jack, and we haven't talked to him in 3 years, but we have an urgent matter. So that happens as well. And I know that happens to you guys. In relation to, so I'm going to use some adjectives. Actually, they could be adverbs as well in relation to, thoughtful, conservative, but not paranoia. I guess paranoia is a noun. So thoughtful benchmarking, thoughtful budgeting, thoughtful forecasting, be thoughtful, and acknowledge what you have going on. So the benchmarking, yeah, maybe a little more difficult, but you know, as far as budgeting and forecasting, it's easy for all of us to have blinders on and just deal with what's in front of us. But there has to be, I believe, a purposeful looking into the future. Now, I'm not aware of anyone having a crystal ball or a DeLorean or a phone booth time machine. So, you know, you have to do it the best you can't go to the future and then figure it out. So, you know, look at the data, put it together, and no one could have predicted, for example, the needed use of technology like cameras, microphones, et cetera, you know, in-house Wi-Fi that is at a faster speed. But those who were in process of or had already done those things had a significant head start at the beginning of the pandemic and in the beginning weeks. Eventually, many businesses caught up because they had to. But so that's just one example of looking ahead and seeing what is there and being able to, and I know some people don't like the word pivot, but I mean, that's essentially what we had to do, is that you're on a course and you had to change the course a little bit because you had to adapt. And so part of that is a good, realistic forecast as to what's going on the revenue side and on the expense side. And I think that putting all those things together will be helpful to moving forward. But like I said, it does take it's hard to do because we're focused on what we're doing. We're like, okay, we'll eventually catch up. We'll eventually look into how to use Zoom. We'll eventually look into how to do these certain things. And then it comes upon us and we're stuck, and we're kind of emotionally and paralyzed. So again, a little bit of a tangent, but just on the topic of look to the future, look into your future purposefully, but conservatively. Don't go nuts.
Along that line, and Bruce, we're going to get to your question next, but I've seen this in so many companies where you say, well, what are your margins? And they'll say, well, they're such and such. Well, when's the last time that you look by customer or by SKU on the margins on that? And that's the thing that blows my mind. Well, we know what they are. Well, when's the last time that you did? And only when they start analyzing that all of a sudden answers appear.
Minds are blown.
Yeah. It's unbelievable. So that's another really important part as you're looking to the future. Look at the present and like do an evaluation by SKU, by client, and it'll be revealing. I have yet to be not surprised. and the teams that do it, all of a sudden they find money.
Yeah, and here I'll give you a good example from BGW. So hopefully, if there are any clients on this policy actually pissed you off, I actually don't apologize, but it because I'm not changing it. However, hey, I hear your frustration. I empathize. Just please work with us. It'll be okay. But we did our own analysis, like Gary talked about, and we've got 3,500 discrete entities that we raise invoices to, and 800 of those account for 83% of our revenue. So it's like, all right, clearly we need to focus on the 800, and designing our services around the 800. Yet invariably we want to change a policy, like we're not printing people tax returns anymore. We're only going to do electronic delivery.
Yeah.
The scream start, well, they're not going to know how to do that. They're not going to know how to download from the portal. They're not tech savvy. They don't have, they don't have any. That's all that is proven to be BS. But that, when you layer on actually what we spend, I mean, in 2020, which is the last time I looked at the data, we spent $75,000 printing tax returns for people that literally threw them away, stuck them in a file drawer, said thank you for that, did nothing with it, then asked us for an electronic copy. All because somebody had a belief that was ungrounded that our clients want that. Like they like to see the effort of our work associated with the size of the page count. They wanted to have their Donald Trump moment. Look at my tax returns that I get. They don't care. So anywho.
Yeah. All right. So Bruce, here's your question. Working capital for foreign operations. Do clients generally rely on local in-country resources for forecasting the needs? Is currency speculation a factor?
Good question, Bruce. So multi-part answer, since there's a multi-part question.
Mm-hmm.
So in terms of the in-country resources question, I think our view on the best practice will be to have, whether it's business segment, because you found that there are different, working capital requirements based on business segment, whatever that is, it would make sense to develop a standard at a corporate level that then gets disseminated to business segments with, kind of very little deviation from that. In other words, like if we both manufacture widgets, but I manufacture them in Brazil and Gary manufactures them in Australia, all else being equal, we probably ought to have about the same working capital target, barring, major differences in terms of lead time to get materials. That may impact things. How much credit is extended by our vendors may impact things. There might be some little nuances, but all else being equal, probably ought to be about the same. So in terms of using in-country resources for forecasting, I think that's fine if you think the team is capable of doing that. But this is a place where if you really want to be on top of your cash flow, you got to develop a process and standards for them, because, otherwise, for all I know, Gary may seem like the most capable person on the planet, but his view of, risk, stock out risk, in terms of like not having the product available, he may be, here's what I think the lead time is, not actually using data. Next thing you know, his inventory turns are a year, when the equivalent division, their inventory turns are 1 month. Well, guess what? Now all my cash is gone. And Gary's going, I need more cash. I need more cash. It's like, well, you didn't need it. It's all tied up in your inventory. So I think you do need to dive in and provide somebody with some, general corporate guidance around how you want to calculate it, the data that you want to see, the standards that you want people to follow. When it comes to currency speculation, obviously when you get back to, a single currency view of things, you're going to have to deal with the currency valuation issues in terms of calculating the currency gains or losses, whether they're realized or unrealized. But generally, if everything's occurring in a country, meaning I'm paying in yen and I'm receiving payment in yen, probably not as important what happens to the yen, other than when you're consolidating back to the corporate level. In other words, if all I ever did was pay in the same currency and receive payment in the same currency, it doesn't really matter that much, because it's all relative at that point. And it only matters in terms of understanding what my accounting profit, truly looks like associated with the currency gain or loss. If, however, I'm raising invoices, in yen, and then at some point I got to turn back around and pay for something in dollars, it absolutely matters. And, generally speaking, at a minimum, I probably would say, beginning of the month, what was the currency rate? End of the month, what was the currency rate? Do some kind of ghetto translation for that month, just to know where kind of where you stand.
Hopefully that answers your question. I figured Robert might want to weigh in on some of that too, just because I know one of his clients does some of that.
kind of relatedly too, and this is something that's come up recently. So I think that localizing when you're forecasting really, it also depends on the nature of the business. So example, represent a developer that has the rights to develop certain franchise units in the entire country of Honduras. And in doing his forecasting and budgeting, presented that to the franchisor, and the franchisor in a nice way was basically saying, that's not accurate, that's impossible. Well, the reason being is that the costs were lower than what they see in other countries, and including in the United States. And the reason being is that they locally sourced certain things, and they had this particular developer has connectivity within the country and has reputation, et cetera. So he is able to do that. So that definitely impacts the pro formas that they create in the revenue projections and the cost projections, et cetera. So along those lines, there has to, if there is local connectivity in that fashion, that needs to be factored in definitely. On the currency exchange, just from a legal perspective, it also, a lot of people in other countries like getting paid in dollars and like transacting in dollars. There's also, and I was talking to Adam and Gary about maybe a future session on cryptocurrency, because as much as I've tried to keep my head buried in the sand on that topic, because it's just one other thing that I have to put into my brain. And I'm like, okay, hopefully I won't have to deal with that in my lifetime very often. It's permeating my life in various different ways. And so that may be something that's up and coming for us to present to all of you on these calls. But so currency is important, but it also depends on what the currency is and what country we're dealing with as well, and all those things fluctuate. And of course, throw in a pandemic and a war in Europe, and all those things play factors into all of that consideration.
Gold bars. Gold bars.
I was trying to avoid it too, Jack, but then Matt Damon started hawking it. So I guess we're doing it.
Yeah, we've got people in it, and our wealth group is going down that path too, to just make sure that we've got options in that side as well. But here's the question. Some employees prefer 1099s and some payroll. Can this work?
Are we recording this? So, I'll let Jack I'm not going to speak too much on the legal side. That'll leave that to you, Jack, because you're going to answer this way better than I am. I'm just going to give you the practical answer from my experience is that, there's a whole bunch of tests on whether I have an employer or independent contractor. And, it's not like absolutely black and white in all cases, all that kind of stuff. So it's more like, well, how's this going to bite you in the ass? How it's going to bite you in the ass is that, here's the situation you want to avoid. I, the employer, Gary's the employee. Gary, dude, you could be an employee, but, be way better for you if you're an independent contractor, because, I could pay a little bit more and then you could deduct your expenses and you'd save on taxes, blah, blah, blah. Okay, sounds great. Bite in the ass number one. Boss man, I owe 20 grand of taxes. I told you, Gary, that I was giving you your taxes. That's why you're getting paid more. Like, you needed to save. I don't have no money. I mean, these are like real things that have happened. Bite in the ass number two. Gary, you suck. You gotta go. Whatever. You're the worst boss ever. Off to file the unemployment claim. What do you mean I don't have any account for unemployment and I can't file for unemployment? Adam screwed me. Like, he made me be an independent contractor. I'm reporting him to the Department of Labor. Then the real pain starts. So the honest answer is usually this bites people in the ass based on a disgruntled employee. I'm not advocating switching people back and forth. I'm just giving the honest answer. It's never been an issue on an IRS audit for us. Knock on crappy countertop that we're in. Maybe it will be at some point in the future. It's always disgruntled employee, Department of Labor for us.
Adam, you're going to jail.
Yay!
So the question was asked as if there's a choice by the employee to make. There is no choice. I mean, you either are one or the other, and there are various tests, whether it is for payroll tax purposes, whether it is for unemployment purposes. And so, but all the things you said are accurate as to the reasons why one might be treated one or the other. But the reality is that if you are the way that the textbook example is, you own a painting company, you have a customer that says, I need this room painted blue by a certain date, and you have someone go out there and paint it. You don't tell them, well, the customer may say, use this paint, but you don't tell them what brush to use, what stroke to use, what cleaning chemicals to use, what hours to keep, et cetera. So that's kind of the textbook example of an independent contractor versus an employee that is totally at your direction and doing things that you tell them to do, specifically how to do them. Now, there may be some discretion, but really that's kind of, and I'm being very general, but that is kind of like the difference of one or the other. So if the employer, the person who is paying the money, is very specific and is your boss essentially ordering you around and telling you how to do things a certain way, then you are an employee. And a lot of times, as you guys know, that's where people get in trouble. It is easier for an employer to just pay wages and not have to deal with the payroll deduction, because essentially what happens in the background, as far as the IRS is concerned, is an employer who takes money from an employee in the form of payroll tax is a trustee of the federal government and is holding that money on behalf of the federal government. And when it doesn't get paid, that's when you get in trouble. And that's why you see in, like, for example, the Business Journal, that the back section where you see these liens and these claims and stuff, it's because employers took employees' money on the auspices of collecting payroll taxes they are required in other taxes, and didn't pay it over to the federal government. And so now they're in trouble, and there's personal responsibility associated with that. So that's a topic for another day. But and from on the employee side, it's like, oh man, I got a lot of money, but I didn't realize I had to pay my own taxes. And then guess what? Not only if you have a person who is misclassified and you treated them as an independent contractor, but they're truly employee, well, obviously the employee is in trouble for not paying taxes, but guess who else is in trouble? The employer. And you have paid money that would otherwise should have been paid by the employee to pay his or her own taxes. Now you get to pay essentially twice, because the IRS is going to say, we really don't care, you screwed up, pay us our taxes, go get the money back for that employee that you paid incorrectly. And by the way, here are penalties and everything else that you need to pay, and interest because you didn't pay us on time on the payroll tax. So there's all kinds of consequences like that. So, when I saw the question, I'm like, okay, it is asked as if the employee has a choice, and they don't. They think they might, the employer might think they might, but they really don't. And yes, the standards are somewhat nebulous as to whether you are or not in some cases, but if you need help looking into that, there are some people on the line that can help you look into that.
Yeah. Since I don't face the risk of disbarment, I don't think, I think on this particular issue, a couple other things to consider that are just, again, real world examples. One is that's very present. If you didn't have employees and you only had independent contractors, guess what you missed out on? PPP, the employee retention tax credit. So you missed out on all the government stimulus just because you didn't want to have to file a payroll tax return. But independent of that, we've had some clients that had independent contractor relationships, and we're doing everything right in terms of, paying by the part or the piece or whatever, like not hourly wages, not telling people what to do. But at the end of the day, if you're a flow through entity, you're missing out on a significant deduction that's currently part of the tax code, which is called the qualified business income deduction, which means that you only pay 80 cents on the dollar for every dollar that you earn. Well, how's that calculated? One of the key tests is it's calculated off of W-2 wages. So it's limited by the amount of W-2 wages that you have. If you have independent contractors, guess what? That's not a W-2 wage. So I remember one case specifically where we ran the analysis, and it's like, look, even after paying ADP to be the PEO, offering health insurance, not making people pay, the payroll tax, number, and kind of eat that over the conversion process, contributing to the 401k, this guy still came out like 150 grand ahead, just because now he got this deduction that he hadn't gotten in the past. So, if you've been doing it for a while, it's worth kind of, let me dust that off and, take a look at it again in terms of the analysis. And I think the other side of that is that, if you've got like, crusty old Barnacle Bill that, pay me as an independent contractor, it's the way it's always been done, that's probably okay, because crusty old Barnacle Bills used to be arrangement, it's not the end of the world in that case. In other words, like if he's critical, I don't know how much I would actually worry on that. So anywho.
All right. So Bruce, I'll just very helpful, very practical guidance, not textbook answer. Thank you. Requires careful analysis. That was regarding the whole foreign stuff. So thank you, Bruce. Appreciate that. And this is good. I knew we could get an answer and a thought out of Robert Mayette on this. So this is on the foreign exchange stuff. So shipping delays are impacting foreign exchange hedging strategies as the windows have to be wider or willing to roll them, or wider or willing to roll them. This adds extra costs beyond the elevated shipping costs. So what ideas do you have to mitigate this added expense? Ooh.
Yeah, I gotta tell you, Robert, you won't like this answer, but it's just my experience. The number of clients that I've had that have actually benefited from a hedging strategy in any time frame is freaking zero. Like, and I'm sorry, not that people shouldn't maybe continue to try. It's just we have not seen it, translate into something truly beneficial and practical within our client base. And I think what I've always wondered is like, why doesn't the bank let me get into their hedging strategy? Because surely they have one. Like when Goldman says, hey, I have a great hedging strategy for you. Here's the product that you can buy, blah, blah, or you can buy this product. It's like, no, I want to be in yours. Like, just put me in the pool that Goldman uses for your own, because clearly that's probably the best one. You're not in the business of losing money on foreign currency exchanges, but you seem to be in the business of taking my money on foreign currency. So I just, the honest answer is, I don't know, Robert, because I really have not seen any of our clients actually. I mean, honestly, I can't even say break even. Like, basically, the range of our client experience on using currency hedges has been lose a little to lose a lot, not even freaking break even. So I honestly don't know. Maybe Jack's got an answer, but I have not. And if you have an answer where it's like, hey, it's really come out ahead,
Can you make an introduction?
Yeah, but we have not had the traditional bank products. Not to knock them. I mean, they're working for somebody. They just haven't worked for our client base.
Yeah, I don't have the magic bullet for that one. I know that the kind of the just in time shipping, I mean, those windows, as has been said in the question, have expanded. And so just kind of dealing within those parameters and just having to stock more and hold more, just anticipation of supply flows, demand flows, and just lack of being able to replenish the supply. It gets you to a place where you're just going to have to stock up, but not hoard as much as possible. So that's not really an answer impacting foreign exchange issues, other than having to spend more cash to get those inventory levels higher and storage costs related there too.
Yeah, I'll tell you, it's embarrassing to say, but the clients that have actually been the most successful in their hedging, and I use air quote hedging strategies, kind of rolls back to Bruce's question about the foreign currency translation. It's been clients that have in-country bank accounts that pay for and receive payments in country, and then just kind of keep track of the currency exchange themselves and repatriate when the rate's favorable. And then when the rate's not favorable, that's just going to stay there, until the rate becomes more favorable, versus buying a product to deal with it. But that requires that you built up a pretty significant cash reserve to effectively be your own hedge. But the people that have been the most successful have been the people that have self-managed, unfortunately, because it really should. If there's a great product out there and anybody knows about it, or there's a great bank out there and anybody knows about it, let us know. But we haven't found it yet, despite all banks having this product and claiming it's the greatest thing since sliced bread.
All right, we've got a couple more questions. This has been good dialogue. We dealt with 2 of the additional 8 or whatever that we had. So, well, I think we may want to continue on this path for another week or so. But Bruce has a question. 1099s that include professional fees and expenses, for example, travel, even if they were billed separately, may even have been paid separately? Is this common practice?
Yeah, because I mean, you're not gonna issue a partial, because that would just be administratively difficult on your part as the person paying the 1099. So it's really on the onus on the recipient of the 1099 to report the gross amount of the 1099, but then claim the proper deductions for what they had in terms of reimbursed travel expenses. In other words, like if I pay Gary 100 grand, but 50 grand of that is travel, Gary's P&L should be 100 grand on the top line, 50 grand of travel expense to land at the same net 50 that he really received.
So the next question has to do with W-2. So this is from Brett. On W-2 versus 1099 question, what if the owner of a business takes a distribution which is then taxed as income on a K-1 and pays casual labor in cash?
This is assuming that you're paying casual labor, meaning like somebody working for you in cash. That's a no-no. Like if you're stuck with it, I guess you're stuck with it, but that's just bad because you're not going to win. You're just not. So if you have to keep on doing it, you can. I mean, there's upper thresholds. I think the upper threshold in cash is $600 or $1,000, per recipient for a year. I don't remember the exact number off the top of my head. So, if it's like $200 and then I never see Gary again, that's probably fine. But if I pay Gary, 20 grand in cash, that's bad. And the reason it's bad is that you're just not going to win on the deduction standpoint, because how are you going to prove it? I mean, a good case where it's like, look, there's nothing we could do is we had a restaurant client that had live entertainment insisted on being paid in cash. And that live entertainment was freaking expensive over the course of the year. Deduction disallowed. Nothing could be done. It sucked. Because how do I know that really went to the band and didn't go into Gary as the owner's pocket? As a fake expense. The other people that were nefarious ruined it for the rest of us. So you're just better off sucking it up and being legit on this one.
So the answer, according to Survival CFO, $600 per year.
Yep.
So, well,
I mean, the other thing too is also that at the beginning of the year, you don't know if you're going to hit that 600 or not. And so, okay, if it's de minimis, that's fine. But I go back to my younger years of being in college and refereeing high school soccer games to make some money at 7:00, run around for 2 hours, exercise, get paid, and then go hang out with my friends at the bar. And the schools would pay you essentially cash, but it wasn't cash, it was a check, and they were keeping track of it. Now, whether or not I reported it or not on my taxes, that's something else that we don't need to revisit, although the statute of limitations is passed, so I'm okay with that. But just to keep that in mind, that at the beginning of the year, I mean, you may say, okay, this is probably going to be 1 or 2 times. What happens if it's more than that? And then you go over the threshold anyway.
Jack, I wonder, I thought you looked familiar. I wonder if you were one of those refs that I used to yell at when my kids were playing soccer. I don't know.
Yeah. And actually I ran into somebody.
He was offsides?
Yes.
Clearly.
Yeah, I have all kinds of stories like that. But I think I may have thrown a now friend of mine out of a game when he was playing for Clemson. And we're trying to figure out, it's like, yeah, there's this short little guy running around in the middle that probably me that threw him out. So
Good man. All right. Let's see. We got, all right. Last question. However, I'm paying cash out of my own pocket after taxes paid by me as the owner, and thereby the income is taxed. Also, the pay to the labor isn't deducted.
Oh yeah, then that's fine, Brad. I mean, if your customer pays you $1,000, and as long as you're reporting that $1,000, you putting that $1,000 in your pocket or depositing that $1,000 directly in your bank account, that's fine as long as you're reporting it. And again, a lot of people are like, oh, it's cash. I love the whole, well, if the cash price is where that bites you in the ass, 2 spots. First off, you go to sell your company, but it's a cash business. Well, good luck proving that. Give you a premium for your business said no one. When you're not fully reporting your taxable income. And then 2 is, guess what happens when you get audited? They ask for your bank accounts. There's no way out of that, so they're basically going to look at the sum of the deposits and then look at what you had as the sum of your gross receipts. And if you can't explain that, Lucy, you got some explaining to do. If you can't explain that, you're done. So it's just better off to be, above board.
Well, hopefully this has helped you guys. Thank you for joining us. Sorry we went a little bit long, but good question. So my gut is we got a whole bunch more of these that I think we may use this to keep kind of stimulating thought, unless something really crazy. It's explained in distributions.
Perfect.
Yeah, there you go, Brett. Okay. Good engagement. Thank you guys for joining us. Really appreciate that. Anybody that came on late, some people did, will be up on the BGW YouTube channel, BGW CPA YouTube channel. It'll be later on this afternoon. So Jack, thank you so much. We'll be back from broadcasting from beautiful Charlotte, North Carolina next week.
Thank you guys.
All right.
See
See you
ya.
guys. Bye-bye.
See you guys.